Technical analysis is all about timing. A stock can be performing very well, but if you make a trade at the wrong price, you can incur heavy losses. That's why traders use various tools to help them make the right decisions in the stock market. And one of the biggest tools they use is Stock Chart. Hello YouTube. Welcome to Roller Coaster. What is a stock chart? A chart is a graphical representation of price of a stock over a certain period of time. In the graphical chart, the x-axis represents the time period, and the y-axis represents the price movement. The time period can vary from a few minutes to even months or years. Types of charts. Technical analysts use a variety of charts based on the information they seek. However, there are three types of charts that are most commonly used. Let us discuss them one by one. Line charts. A line chart is the figure that, perhaps, automatically comes to mind when you think of a chart. A line chart is probably the most common type of chart. This chart tracks the closing prices of the stock over a specific period. In daily time frame, each day's closing price point is represented by a dot. And all the dots are connected by lines to get the graphical representation. While it is considered to be quite simplistic, it does not offer much information regarding intraday price movements. Bar charts. A bar chart is quite similar to a line chart. However, it offers much more information. Instead of a dot, each plot point in the graph is represented by a vertical line, with two horizontal lines protruding out of it on either side. It is represented as follows. In daily time frame, the top part of the vertical line represents the highest price at which the stock had traded during the day. Similarly, the lower part represents the lowest traded price. The left extension represents the price at which the stock opened, while the right extension represents the closing price for the day. In addition to offering greater detail than a line chart, the bar chart also gives insight on volatility. The longer a line is, the higher is the difference between low and high prices. This means higher volatility. Candlestick charts. Candlestick charts are very popular among technical analysts. They offer a great deal of information in a very precise manner. As the name suggests, in daily time frame, the price movements for each day are represented in the shape of a candlestick. It is similar to a bar chart as it represents the four data points: high, low, open, and close. In addition, the candlesticks come in different colors based on the price movements. In the above picture, it is clear how the values are represented in the form of a candlestick. Candlesticks are of two shades. On days when the closing price is greater than the opening price, they are of a lighter shade, normally white or green. It signifies bullishness or buying. On days when the closing price is lower than the opening price, they are of a darker shade, normally black or red. It signifies bearishness or selling. Compared to traditional bar charts, many traders consider candlestick charts more visually appealing and easier to interpret. In this video, we will be continuing our discussion in candlestick charts. Candlestick charts are thought to have been developed in the 18th century by Munehisa Homma, a Japanese rice trader. They were introduced to the Western world by Steve Nissen in his book, Japanese Candlestick Charting Techniques. In the 18th century, a wealthy Japanese businessman, Munehisa Homma, developed a technical analysis method to analyze the price of rice contracts. Homma, from Sakata, Japan, began trading at the local rice exchange around 1750. He kept records of the market psychology, learning to boost his profits by carefully monitoring prices and not to rushing into trades. He is regarded as the grandfather of candlesticks because of his research on price pattern recognition. He discovered that, while there was a link between price and the supply and demand of rice, the markets were strongly influenced by the emotions of traders. Candlesticks show that emotion by visually representing the size of price moves with different colors. Traders use the candlesticks to make trading decisions based on regularly occurring patterns. Candlesticks are created by up and down movements in the price. While these price movements sometimes may appear random, but they convey certain message. Traders use this for analysis or trading purposes. Depending upon the open, high, low, and close price, there are different combinations that can be formed. There is no need to understand all these combinations. In this and coming videos we will discuss very basic and effective candlesticks. Few important points to remember. First, the largest part in a candlestick plays the most important role. This can be upper wick, body, or lower wick. Second, when a trader is buying, it should be in white or green candle. Similarly, if a trader is short selling, it should be in black or red candle. Don't forget to like this video and please subscribe the channel. Let us start with the first candlestick. Marubozu. The word Marubozu means bald head or shaved head in Japanese. This is reflected in the candlestick's lack of shadow. In an ideal Marubozu, there is no upper or lower shadow. Candlestick body is the only part. But, these are also acceptable forms of Marubozu. A small upper or lower shadow, or both can be seen. But, these should be comparatively insignificant to the size of a candlestick. Bullish Marubozu. The absence of the upper and lower shadow in a bullish Marubozu implies that the low is equal to the open, and the high is equal to the close. Let us understand market psychology behind this candlestick. A bullish Marubozu indicates there is so much buying interest in the stock that the market participants were willing to buy the stock at every price point during the day. Also, buying interest is so much that the stock closed near its high point for the day. The expectation is that, with this sudden change in sentiment, there is a surge of bullishness, and this bullish sentiment will continue over the next few trading sessions. Hence, a trader should look at buying opportunities with the occurrence of a bullish Marubozu. The buying price should be around the closing price of the Marubozu. Candlestick patterns come with an inbuilt risk management mechanism. In case of a bullish Marubozu, the low of the candlestick acts as a stop loss. So after one initiates a buy trade, and the stock move in the opposite direction, one should exit the stock, if price breaches the low of the Marubozu. Bearish Marubozu. Bearish Marubozu indicates extreme bearishness. Here, the open is equal to the high, and the close is equal to low. Let us understand market psychology behind this candlestick. A bearish Marubozu indicates there is so much selling pressure in the stock that the market participants actually sold at every price point during the day. Also, selling pressure is so much that the stock closed near its low point of the day. It does not matter what the prior trend has been, the action on the Marubozu day suggests the sentiment has changed, and the stock is now bearish. The expectation is, this sudden change in sentiment will be carried forward over the next few trading sessions, and hence, one should look at shorting opportunities. The selling price should be around the closing price of the Marubozu. The high of the candlestick acts as a stop loss. One should avoid trading during a minimal, that is below 2% range, or long candle that is above 10% range. A small candle indicates subdued trading activity, and hence it would be difficult to identify the direction of the trade. On the other hand, a long candle indicates extreme activity. The problem with lengthy candles would be the placement of stop loss. The stop loss would be deep, and in case the trade goes wrong, the penalty for paying would be painful. Also, after this much gain, there are chances market participants can start booking their profits. For these reasons, one should avoid trading on candles that are either too short or too long. This is all just textbook knowledge. Let's see how a Marubozu looks in a stock chart. These candlesticks can be easily spotted in charts. Look at this candlestick, it is bearish Marubozu. As discussed, the bearish momentum should continue. But in next trading sessions, a bullish Marubozu can be spotted. The momentum continues over next days. The stock can be seen going up. Again, a bearish Marubozu can be spotted. And again, the bullish Marubozu is seen in next trading days. After that, the stock goes up. Now check out this candlestick. This instance, the bearish momentum continues after formation of bearish Marubozu. Practically, it is difficult to guess whether momentum will continue or not, especially for the beginners. But, there are setups where the effectiveness of these candlesticks increases dramatically. We have discussed concepts of resistance and support in previous video. We talked about breakouts. Please check out the link in description. Formation of these candlesticks is seen during breakouts. Let us see some charts. The stock is in uptrend, facing resistance at this level. It is seen breaking the range. During breakout, a bullish Marubozu is formed. In this setup, there are higher chances momentum will continue for next trading sessions. One can buy above closing price. Stop loss is to be placed near candlestick low. Profit can be booked at 2 times the stop loss. The stock is in uptrend, facing resistance at this level. It is seen breaking the range. During breakout, a bullish Marubozu is formed. In this setup, there are higher chances momentum will continue for next trading sessions. One can buy above closing price. Stop loss is to be placed near candlestick low. Profit can be booked at 2 times the stop loss. The stock is in uptrend, facing resistance at this level. It is seen breaking the range. During breakout, a bullish Marubozu is formed. In this setup, there are higher chances momentum will continue for next trading sessions. One can buy above closing price. Stop loss is to be placed near candlestick low. Profit can be booked at 2 times the stop loss. The stock is in uptrend, facing resistance at this level. It is seen breaking the range. During breakout, a bullish Marubozu is formed. In this setup, there are higher chances momentum will continue for next trading sessions. One can buy above closing price. Stop loss is to be placed near candlestick low. Profit can be booked at 2 times the stop loss. The index is in uptrend, facing resistance at this level. It is seen breaking the range. During breakout, a bullish Marubozu is formed. In this setup, there are higher chances momentum will continue for next trading sessions. One can buy above closing price. Stop loss is to be placed near candlestick low. Profit can be booked at 2 times the stop loss. The index took support at this level. It is seen breaking the range during COVID-19 induced sell-off. During breakout, a bearish Marubozu is formed. In this setup, there are higher chances momentum will continue for next trading sessions. One can sell below closing price. Stop loss is to be placed near candlestick high. Profit can be booked at 2 times the stop loss. Also, if a person is holding stocks, and such breakouts are seen, it is advised to exit the stocks for short term. There are chances the stock may change its trend, or a heavy correction is about to come. For majority of stocks, this pattern is seen during COVID-19 sell-off. With this, I'll wind my video. I request you all, please keep stop losses in all trades, and limit your quantities, especially if you are a beginner. Please inculcate these habits from beginning. Also, look for these patterns in more charts. And if you have any questions, please post in comments section. I would love to clarify those. Thank you.